Unless you've been living under a rock, you're probably aware that Cardano is up pretty much recently. We're looking at a gain of 41% in the last 300 hours. Now, why is that? It's because of the Vasil Hardfork on 30th of June, so end of this month. And so what does this translate into? When we look at the main coins ordered by market cap, we can see Cardano here at place number 6 went up by 13% in the last 7 days, whereas Bitcoin and Ethereum were somewhat stagnant. Now, I think it makes sense to try to time the market in a certain way. Some people disagree. Some people just say, okay, buy and hold, no matter what comes. But I personally, I'm somewhat scared of these 98% drops that can happen, right? It happened here historically in Cardano, even during a rather short period. Yeah, this is a 1 month period. We've seen a 70% drop. So I personally like to try to time those waves in a certain way. A pretty straightforward way to do this is to use moving averages. So let's say we've got this moving average over here. We would be selling whenever the price is below the moving average. We would be buying whenever it is above, right? So that we take advantage of the positive momentum where we go up by 100%, but we are not in the market when the price goes down, say by 54%. You could even do a bit more of an extreme approach, and instead of just exiting the market, you could be betting on falling prices during these bearish times, right? Currently, according to this random moving average, we would be bearish. We would not be buying Cardano. But here comes the problem, right? The question is, what is the ideal duration for that moving average? Should we take, as in this example, the 100-day, or should we maybe go a bit smaller on this duration? Meaning we would be reacting quicker. For example, over here for exiting, we wouldn't wait as long, but we sometimes might have these failed signals. So what's the ideal duration? Is it maybe the 15-day and we should be buying and selling relatively often? Or is it rather a longer term moving average? We can actually find this out by simulating buying and selling the asset. And that's what this Excel sheet is for, which you can, by the way, also download for the premium members at thebitcoinstrategy.com. Link is in the video description. So I've already exported the data over here. So when you go to tradingview.com, you click over here, export chart data. I think you do need the licensed version of TradingView in order to do this, which is around $25 per month or so. Once you've got that, you can export the chart data, then get this into the Excel sheet. So the data here starts on the 1st of October 2017, where Cardano was 2 cents. Believe it or not, Cardano was at 2 cents one day. And it ranges all the way, of course, to today, the 9th of June 2022. Now there's a macro in this Excel sheet, a little program that does the simulation. And in here, we can set various parameters. So we can set, for example, that we want to buy whenever the price is above the moving average, and we are maybe just in cash when we are below. Alternatively, we could simulate to also bet on falling prices. That's when we would put a 1 over here. But let's for now just simulate being in cash. Let's set our initial capital maybe at 1,000 US. And then, of course, we've got a trading fee, right? When we buy, we pay it once. When we sell, we pay it once. I currently set 0.1%. That's the non-discount rate at Binance. And so let's run over the different moving average durations. So the daily price ticks, right? So we are having here in tradingview.com the day selected, meaning the prices that get recorded over here are at midnight UTC. And let's find out with this simulation what kind of moving average works the best for Cardano. So I'm clicking here, iterating over the simple moving average and the exponential moving average, also the double exponential moving average, by the way, if you're interested in that. Let's see what in the past worked best. And so we can see buying and holding annualized would have given us 93% per annum in Cardano. And when we trade according to different moving averages, we tend to outperform this pretty significantly, right? 330% over here. Let's look at all of this data in chart format, actually. So here on the x-axis, we've got, again, the duration, the moving average duration. And on the y-axis, we've got the annualized performance. In black, we see buying and holding, right? Which, as said, would have given us 93%. So we can see trading almost according to any moving average would have outperformed buying and holding. So timing the market historically worked pretty well for Cardano, both for the simple as well as for the exponential moving average. Now, why is that? Let's scroll down and look at this. In white, we see the Cardano price. In green, we see the trading history, as in how would our portfolio develop over time. This is a linear scale though, right? So this $1,000 with the trading strategy would have given us 500,000 by the end, right? So that's now with the 52-day. Let's actually cherry pick here a little bit. Let's maybe take the best simple moving average. So let's first switch this to 20 over here. And for the exponential one, let's take this point, the 39-day. So now we've got the two best moving averages looking at what would be the best kinds of return. And this is what we are getting. This is now the linear scale. We would have come to almost $1 million by the end of this simulation. But of course, we can't really know these kind of moving averages beforehand, right? So nobody can say this for sure. But when we look at this on a logarithmic scale, so instead of now going 200K 1-to-1, we are now looking at a 10x for each of those increments. We can actually see why this outperforms so well. It basically outperforms because when the crashes happen, we tend to be outside of the market and the portfolio line is completely flat. So nothing is really happening here. We are just in cash. And we tend to go up, then we also tend to go up. And when a crash is really significant, we still don't really make money that much, right? We are still going somewhat sideways because we still try to sometimes catch the falling knife, but it's way less of a downturn than if we were just buying and holding. And this is why this whole thing is outperforming, right? Cardano went down quite massively from like $3 to a few cents right now, like 60 cents or whatever it is, 64 cents to be more specific. But we would have lost way less with this strategy. We would not have gained, but we would have lost less. And that kind of outperformance is then amplified because this compounds, right? This compounds to the degree that then on a linear scale, this is really a massive difference. So that's in the end what 90-something% versus 330% actually make, right? Over time, over all of those years. Now, this is only working with the buying whenever we are above, right? So we would be bullish in this case, and we would be bearish and be completely in cash during these times of price action. We would have bought, for example, over here and then sold the next day afterwards with a loss because of this fake out of 13%. And these kinds of fake outs are then the reason why we still tend to lose a little bit during a down period, right? Because we can't time this perfectly. Now let's actually look at this in the chart. So the best simple moving average is the 20-day historically for Cardano. So let's adjust this to 20 days. This is what we get. And we would have actually been now bullish since the 30th of May, meaning we would already be in profit for like 13% or so. Quite impressive, I think. But let's actually go a step further and simulate betting on falling prices. Note, sometimes, right, we do get quite a lot of noise with this, right? So we would be buying, selling, relatively often, probably not making money, right? At least losing money due to the trading fees. But maybe when we bet on falling prices during these kinds of moves, we could still make even more than just by being in cash. So let's do this. Let's change here that we short on short signals. So we bet on falling prices whenever the Cardano price is below its moving average. And let's again iterate over all of those moving averages. And the duration that we will be getting is still the same, right? We will still see the best kinds of moving averages outperform, but the degree, the magnitude to which they outperform will be different. And this is what we are now getting. So again, the 20-day is the best, but look at that delta, right? This is 856% per annum. Now that's a very different game to 93% per annum, right? And look at pretty much how every moving average here is still outperforming and to what kind of a degree. It's very, very impressive. Here, look at this on a linear scale. You can barely see the Cardano price here. And this is what I mean why these backtests are so useful. They really give us an insight into the psychology of the market. Crypto markets are really moving in waves. They really move with momentum. When prices tend to go up, the tendency is that they continue to do so, and vice versa. So of course, sometimes the trends, they do reverse, right? Sometimes go up, sometimes go down. But when you are already up, it's more likely that it continues to go up. And that's at any point true. But as with everything with likelihoods, right, sometimes the unlikely actually materializes itself, and that's then when the trend turns around. But it does make sense to ride the waves. And you don't even have to be an expert to ride the waves. You can take any kind of moving average and you're still doing better than just buying and holding. This is impressive, right? Let's look at this on a linear scale. This is, by the way, the 52-day, so this isn't even the best. Let's actually go with the best here, the 20-day simple moving average. This is what we are getting, right? This is ridiculous what kind of a consistent, impressive outperformance this is. Look at how little downside we actually have. See how we easily go 90% down, right? This is 10x of a difference. So from here to here is 10x, but the other way around is 90% down, right? Once we cross from one line down to another line, we are 90% down by buying and holding. We did see this almost once here during the sideways movement in 2021. This is where the strategy loses, right? This is where we get all these failed signals, but that's about it, right? If we don't have just straight sideways movement, the strategy tends to really perform well and tends to outperform. So I think that's quite nice. So again, the best exponential moving average is the 39. So let's also look at that. Let's maybe also plot this now in the chart, because why not? So we add an exponential moving average, change this to 39. This is what we get. Quite nice to have two different kinds of durations that in the end perform similarly, because it can give us a bit of a more complete picture, I would say. So for example, maybe we could have ignored this fake out if we just waited until the exponential moving average gets crossed. And this is now a very, very, very interesting point, right? We have just crossed the exponential moving average here as well. We don't know if this will hold up, right? Sometimes we do get, still after an exponential moving average cross, our fake out and it goes down, and we would have been betting on rising prices here. But still, historically, right, over the long term, this tends to work pretty well. Now, this is the simple moving average backtest. Let's look at the exponential one. So that's this one in red. It's interesting, right? The volatility here seems to be less, because in the simple one, we went down by almost one order of magnitude here, which did not happen for the exponential moving average. It's less volatile. So even though the return here is slightly less, annualized, it's 809% versus those 856%. Even though the return is less, the volatility of that return is also less. So I almost tend to believe it makes more sense to go with the 39 exponential moving average. Even though the return is less, I kind of like how this is just going straight up, right? This is like the kind of a dream return you want to have in any kind of approach. Now, we can even refine this further. And this is also part of this Excel sheet. By the way, let me make a little shameless plug over here. This is the premium membership where you get these daily videos, daily market updates on various projects, where you then can also here in the statistics library download all of those sheets. So I will also upload the sheet of this video in this library once this goes live. There's a lot more things, right? Like a technical analysis academy where it's shown how to actually build such a sheet. A lot of interesting stuff. So you can get all of that at thebitcoinstrategy.com. Link is in the video description. It's currently $49 US per month. But let's now continue actually with this backtest. So this is the next refinement that we can potentially do. When we look at these sideways trading moments, right, like over here, we see sometimes these failed signals. Let's zoom in a little bit. We can see these failed signals that just barely cross the moving average, right? They barely cross and they give us these wrong impressions. So let's maybe just take one of those. Let's take the simple moving average. You would have bet here on falling prices, just to then bet on rising prices again, falling on rising prices, then on falling price again. So it would be buying, selling, incurring trading fees, and also doing the exact opposite of what we should do, right? We would be selling low and buying high, and then buying high and selling low. So these kinds of moves are not really nice. So maybe when we have some kind of a minimum crossing buffer, we can even improve this a little bit. So I haven't yet run the numbers, but let's do this together and see if this actually works for Cardano. It doesn't work for every cryptocurrency. For most it does though. So maybe we have to say, okay, only if we cross that moving average by 1% or 1.5% or something, only then we take this as a valid signal. So that's why we've got this iterate over buffer over here. So we're now going to look at different minimum crossing buffers. Let's still go long in the positive case and short in the negative case. So bet on both directions. Let's now find out if we actually have a buffer that's better than just directly trading according to those moving averages. So let's click on this, iterate over the buffer. And we can see when there's no buffer, the returns are the exact same as for the simulation without buffer. So we can cross check this soon. It flickers a little bit, it moves back and forth, but there we go. So I'm now back testing the best buffer for the 20-day simple moving average and 39-day. And this is what I mean, right? This is the 20-day simple moving average, no buffer, no buffer. And then we've got the different returns with a buffer. And so again, of course, we have this in chart form. So let's scroll down over here. And on the x-axis, we've got the buffer. And on the y-axis, we've got the annualized performance. And we can see for the simple moving average, we might actually want to take a bit of a buffer. We don't want to take too much because then we might lose some momentum. We also don't want to take this kind of an outlier over here because this is really randomness, right? 14.8% and it's only one data point. If you take just a little bit below or a little bit above, you're already underperforming just this line over here, right? This is what we're looking at, the 0 point. We want to be higher than the 0 point. So the best buffer here is 1.4% for the simple moving average. For the exponential moving average, none of the buffers actually work. So the buffer approach in general doesn't work as consistently as the moving average trading approach, but still let's at least plot this 1.4 for the simple moving average. Just look at this, how this changes things. By the way, the change here is not massive, right? This is from 856% per annum to 937. Still, right, compounded, it makes a lot of difference in the end in terms of US dollars, but just relatively speaking, right, this is not a massive difference, but still we might want to consider this. So let's look at this in the chart. Again, let's look at the exponential one still, the 39, and the simple one, the 20. But let's now look at something called moving average bands. So I press /, I enter MAB, moving average bands, click over here. Let's take away the regular 20-day moving average. Just look at the moving average bands, double click here. We want to get the 20. We want to have a deviation of 1.4%. So let's do that. And we are working with the simple moving average, right? And the closing prices is our source. So this would now tell us, let's maybe change the style a little bit. So plot this in a similar way as we've done before. We would now not be selling when we go below this moving average. And we would not be buying when we go above this moving average. We would be waiting until we actually cross the lower band here for selling. And we're waiting until we cross the upper band over here before buying. Okay, so we have a bit of a buffer, meaning we don't overtrade that much when we are very, very close to the moving average with low volatility. It avoids some of those failed signals, right? So for example, over here, we would go long here, right? So no matter if you have a buffer or not, here we zoom in, we would go long on this day, the 5th of April. And then without the buffer, we would already go short again on the 7th of April. We'd be betting on prices over here. But with the buffer, we ignore this signal, meaning we stay positive, and we only exit over here on the 19th actually, because on the 18th, we haven't yet crossed the lower band. So this is an example of a negative trade, but we would have avoided one of those negative trades over here. So 1.9% would have been the negative performance here from this day to this day. But without the buffer, we would have bought over here and sold over here for 3.2% and then made another positive trade of 1.4 or so. So using a small buffer around these moving averages sometimes works, at least to a certain degree. So I think it makes sense to also plot this. Now, what's the current situation, right? This is probably the reason why you're looking into a video like this. What's the current situation? We are above both moving averages. very positive. We have just crossed what I think is the better of the two moving averages. So the 39-day exponential moving average. By the way, if you're interested, what are the best moving averages for other assets? We've got a dedicated section for that here in the premium membership. So feel free to check that. So does it make sense to be bullish now on Cardano? Possibly. Historically, this is a good sign. There are, of course, points in the overall market that are not yet that bullish, right? When we look at the best moving averages, by the way, for Bitcoin and Ethereum, we are still below both of them. And overall, crypto does have an influence on altcoins, right? There is high correlation between the general market and each individual alt. So when all of crypto is going down, Cardano has a harder time. But we can see when the stars align correctly that even though the market doesn't do much, Cardano can still make money. Now, there are, of course, a lot of other things to discuss over here, right? I'm just looking here at the technical analysis, at psychology, at trading momentum. And of course, the long-term technical development is very important to discuss as well. But I think it sometimes gets too much attention, to be honest, because the fundamentals, did they really deteriorate by like 98% or so during this 1 year? Probably not, right? This was driven by the overall market collapsing and by the inherent leverage that is in altcoins compared to Bitcoin or Ethereum. So I think psychology and momentum and trends are very important, as we have seen with those backtests here, right? It doesn't even matter what kind of timescale you use here. Any timescale works. So really going with the overall trend, with the overall momentum, with the flow where the current market is headed is almost more important potentially than whatever we see on CoinMarketCal, for example, for the different new releases that come up. These are the drivers that cause the positive momentum, that cause the positive psychology. But once that is established, it's still important to ride the wave and time this right. That's what this backtest here is used for. Now, if you're the first time visiting this channel, then don't forget to subscribe, because I do publish videos for free regularly on this channel. So there's not just the paid content, there is still the free content here. And of course, a like on the video would be appreciated as well. More information on the premium membership is here in this video. Hope to see you there. And of course, thanks for watching this one. Bye bye.